So this is maybe your first look at actual financial statements as reported by a large company. In this case, Marriott International or Marriott Bonvoy, a owner-operator of a hotel and hotel chains. So first statement we are looking at here is a statement of income or income statement. They have loss in parentheses because one of the years actual expenses were more than revenues. But notice the format that we notice in the heading. This is going to show us the information for 3 years, 2018, 2019, 2020. So we can compare and look across and see the trend in how they're doing financially on this statement. So remember that the income statement is going to talk about revenues and expenses. We learned what those meant in an earlier earlier chapter. So revenues is what they've earned, and you can see here that very quickly you can see the impact in 2020 of the worldwide pandemic. Revenues, or the amount that they were able to increase assets by selling things, hotel rooms, was cut almost in half because people couldn't travel and weren't staying in hotels. They were also able to cut the expenses because they didn't need to spend as much money or use those. And expenses, of course, is that reduction in assets or increase in liabilities to be able to earn our revenues, the costs that go into that. And those were cut significantly, but not enough to avoid the fact that there were more expenses in 2020 than there were revenues earned. And so that is our first glimpse at an income statement on revenues and expenses and the relationship there. We don't need to know what all the terminology means on a statement like this to understand that the things that happen under revenue or listed under revenue are the inflows of assets because we've done something for our customers. The expenses are the costs or the things we have to spend or use to earn those revenues. And so that's the generic. We may not know exactly the detail, but we have an idea of what it is that we're describing because we understand the definition of revenues and expenses. Well, of course, having more revenues than expenses is our goal. That's the idea. That's how we are going to judge our profitability or our financial success, at least in some certain way. So we scroll down a little further, we've come to the balance sheet. And here Marriott International shows us assets. We know what assets are. These are resources that they own or control, that they are using to create revenues that are and will bring us future benefit. And so they are listed with those that are going to be benefit the next year first, and then those that are going to benefit further. And we see some of the things. Again, we don't need to know exactly the definition of each of the assets to know that they are what Marriott International has determined under GAAP to be the resources or assets that they can use and that they will bring future benefit. And these are the total amounts of those various assets. And we can see which ones are significant, and we can compare to the year before and see which assets were increased, which ones stayed the same, which most of them did, and that sort of thing. Then there's the liability. This is what we owe. This is our obligations to pay. And this is indicated again with current, those that are due in 1 year or less, and those are doing more. And then the difference between our assets and liabilities is our equity, also shown on the balance sheet. Again, 2 years, we can see the changes between the 2 years. We can see what the significant dollar amounts, what kinds of liabilities are owed by Marriott, and what is represented by the owners. What is their investment as part of the stockholders' equity. Then the cash flow statement. The statement that tells us how much our cash changed for, again, 3 years, telling us how we got more money cash-wise and how we spent that. So we can a negative will be money spent or a reduction in cash, and a positive will be an increase in cash. So we have 3 sections in the cash flow: the operating, investing, and financing activities that describe what changed in terms of our cash balance, how much money we have in the bank. And then finally, a statement of changes in equity or changes in retained earnings. Doesn't typically provide as much information as the other statements, and yet very important to get things to work together. It describes how the income statement is related to the balance sheet, in that when we have revenues and expenses, that affects our equity, which is a part of the stockholders' equity on the balance sheet. But before we can know what the stockholders' equity on the balance sheet is, we have to show the changes in equity on the statement of equity or the statement of changes in retained earnings. And so while it seems to be less important, it cannot be skipped. Otherwise, the statements don't work together. So there's your first glimpse of these pages, and then just to give you a feel for that, that's you might say the numbers, and then the next 26 pages or so are some descriptions and explanations in the footnotes. That idea of non-financial information that we talked about, it describes the numbers. There'll still be plenty of numbers, charts, graphs, things like that in the footnotes, but they will use a lot of descriptions and explanation to help understand the detail and how they apply the general principles we learned in Chapter 2, the conceptual framework, to their specific information that they have in their financial statements.